You are going to learn about an extraordinary trading system. It's a new approach to market-neutral trading. The strategy does not rely on your choosing the correct market direction. You won't need to short stocks, so you can trade this in your IRA account. It can be described as pair trading, but there is an entirely new twist that I'm introducing. This strategy will make a good profit a high percent of the time. It can generate excellent annual returns while only exposing a small portion of your investment funds. A little later, I'll show you our remarkable testing results. Have you ever bought a stock only to watch it immediately go down? If you have been investing for any period of time, you have had this happen to you. I know it has happened to me. With the recent market volatility, as seen the first week of August 2011, the Dow Jones Industrial Average went down 638 points in one day and up 646 the next, only to go down 536 the following, and the next day it went up 544 points. Most people cannot trade this type of market. Some try, but few succeed over time. With this strategy, you can. If you had stops on, were you pleased with the results? Instead, consider a market-neutral strategy. You don't care whether the moves are up or down. You will make money in either case. You won't even need stops. In fact, unlike an iron condor, the farther the market moves, the more money you make. This market-neutral strategy is sometimes called pair trading, statistical arbitrage, relative value arbitrage. It goes by several different names. Large investment banks, institutions, and hedge funds spend millions of dollars each year developing pair trading strategies, but they have kept them hidden from the public. The pair trading strategy can provide low risk and high reward returns to their investors. Recent studies show that this style of investing has lower risk than any other style of investing, especially in volatile markets. This example pair trades Coke and Pepsi. Both companies are in the same sector and both sell very similar products. Their stock prices are closely related, as you would guess, and their price moves are similar over time. However, frequently their prices diverge for short periods. You might see Coke move up while Pepsi goes sideways or moves down. When you see that, you can short Coke and buy Pepsi long. When they revert to their means, you make money, i.e., when they resume their normal correlated moves, you profit. By the way, in late July, around here, when their prices fell, if you were long Pepsi and short Coke, you have not lost money, surprisingly. The short on Coke fully protected the loss on the long Pepsi position. Note, In an IRA account, you cannot short a stock, so you wouldn't be able to do the Coke-Pepsi trade. However, with a Counter-Condor strategy, inverse ETFs are going to be used, so you'll be able to accomplish what you want. Here is another example, Google versus Yahoo. Yahoo is the red line and Google is the blue. Google and Yahoo are both search engine providers, among other things. They both have very diversified offerings to the public. Historically, their prices trade similarly. Just look at the left portion of the chart. However, at about the middle of the chart, you see that Google went sideways, but Yahoo dropped in price and then went sideways. When you see divergence in the two related stocks that normally trade similarly, it is the time to start watching. This is an opportunity to sell short Google and buy Yahoo long. Alternatively, you could buy puts on Google and buy calls on Yahoo. Your expectation is that eventually they will revert to the normal trading style. When they do, you will profit. Your risk is relatively low because you are short one underlying and long the other. When Yahoo began its march up to get back in step with Google, you would close your positions in both holdings. If you had put on this trade and subsequently the market had crashed, your position would have been hedged and you would not have panicked. This is the protection pair trading provides. Now that you have some understanding of pairs trading, let's get into the nitty-gritty. Here are two examples. At the top are two ETFs, which are 3 times leveraged for the Russell 2000. One is the inverse of the other. Below are the 2 times leveraged ETFs for the S&P 500. Like the TNA and TZA, they are inverses of one another. If on a given day I had bought both TNA and TZA, at the end of the day, I would expect to have neither a profit nor a loss, whether the market had moved up or down. The same applies to SSO and SDS. The next image will show you this is not what you would expect. Here is a chart that will help you understand the concept of inverse ETFs. As you can see in this instance, we have chosen TNA, the bullish 3 times ETF, and TZA, its inverse, the bearish 3 times ETFs. A 5% move in the underlying IWM would result in a 15% move in both TNA and TZA. Of course, TZA would be in the opposite direction. Plotted on the same axis, you will see that they are inversely related. When one goes up, the other goes down. This reminds me of a Rorschach. Their prices look like mirror images. If these pairs were constructed perfectly, their charts would be symmetric about the zero axis. But that is not the case. As you can see, their center line falls at a rate of about 4% per month. Call that 4% friction in the system. Direxion, the company that provides these 3 times ETFs, have costs of operation. They need to make a profit too. This phenomenon is where my study began. I wanted to see if I could take advantage of the friction. What really happens is that TNA might go up 4.5%, while TZA goes down 4.4%. They aren't really perfectly matched. First, I wanted to be able to trade a new class of ETFs rather than individual stocks. In order to eliminate the traditional pairs trading requirement of shorting, I wanted to be able to pair trade in an IRA. Additionally, these TNA TZA ETFs are a derivative of the Russell 2000, represented by the ETF for the index IWM. There are 2,000 stocks in IWM, so we have diversity. I began attacking the problem by testing to see if using options on TNA and TZA could produce the desired results. Here are a couple of results from my early tests. As you can see, you wouldn't have liked trading either of these strategies. Nearly all the trades were close to 100% losers. Like Edison, I doggedly kept trying until I eliminated all the strategies that didn't work, and I finally found one that did. Here's the winner I found. It employs 2 special vertical spreads, each in the same direction, but they will be traded on the paired ETFs facing in opposite directions. The spreads are constructed to preserve market neutrality, so that one of these spreads loses value, the other one gains. Because these ETFs are leveraged, a small market move will cause them to diverge. Their option spreads will diverge as well. By choosing narrow spreads, an ideal trade will result most of the time. That's how I finally succeeded. Once the positions have been entered, this is truly a couch potato strategy. Agility is not required. Neither are stops. I put on the 2 spread trades with 3 to 5 weeks till expiration. Then I close them, usually on expiration. You can have losing trades, but they are not frequent. You must plan on the possibility of 2 or possibly 3 losing trades in a row. Unlikely things do happen. As this phenomenal chart shows, it had an average gain well over 30% per trade, and better than 90% of the trades were winners. That's pretty good for a couch potato strategy. I wish I had used real money. By the way, theoretical data was not used in these tests. Thinkorswim, a sophisticated brokerage service, provides actual option trade data in its backtester. Therefore, we used actual trade data rather than computing the theoretical price of the options. In spite of the performance, option trading requires preparation for the worst. It is always possible to have multiple consecutive losing trades, and even in 100% losing trade. Therefore, I am recommending a strong money management allocation policy. Let's assume we have $100,000 available for investing. We're only going to risk 10% of our account by allocating $10,000 to each trade. In addition, let's say the average win is 25% and the maximum drawdown is 20%. Reviewing our data, this allocation plan results in a very small drawdown. The largest losing trade was less than 20%. Actually, it was 12.7%. And the average win was much better, 38.95%. But under the assumed circumstances, the fixed allocation policy gains 300% in a year. The $100,000 account realizes a 30% growth rate with only a 2% drawdown. There is no need to be greedy. The Counter-Condor strategy, like the Iron Condor, is constructed of two spreads. These are their profit-loss profiles. The black curve is the result of combining the two spreads. You can see one is bearish and the other is bullish with respect to the underlying index. Generally, each trade is designed around a credit and a debit spread. The potential profit is the ratio of the net credit and the risk. As long as the market moves both underlying ETFs at least 1 point, the strategy pays off at the level of the wings, no matter the direction of the market. Let's review some of the characteristics of the Counter-Condor. It trades inversely correlated ETFs. For example, TNA and TZA, or QLD and QID. QLD and QID represent the Qs, namely the NASDAQ 100. All trades are naturally hedged. Stops are never used. The strategy is allowed in IRAs. It does not short stocks, and it profits from both rising and falling markets. An extremely high percentage of trades are profitable. This is based on both paper trading and live trading. Well over a majority of the trades had more than a 25% profit, and it demonstrated a low drawdown. It's the ideal couch potato strategy. Once the trade is entered, just lay back and relax. Okay, go ahead and ask the dumbest question you can think of. You will make other participants feel good. They were thinking about it, but didn't ask it because they didn't want to look stupid. There are no stupid questions. Oh, here's a question from Lou. Has the October trade already been made? Some people have put on the October trade, but I am still sending out notices because there are 4 weeks remaining until expiration, and some members may not have placed their trade. Here's a question. Do you leg in? No. Each spread is put on as one trade. I recommend putting on the credit spread first because it is a little more difficult. Kathy from Atlanta asks, are the only ETFs, TNA, TZA, QLD, and QID the ones that we trade? Have I considered GLD and OIL? So far, only those two. I can easily look into GLD and OIL. Alan is asking, am I looking for stocks that are mean reverting? No, I'm focusing on only inversely correlated ETF pairs. These ETFs are derived from broad-based indices. This provides us with diversification. Furthermore, with stocks, it involves shorting, which I want to avoid. Mike asks if I'm looking for a difference in the ETFs before entering. No, I only look for a good net credit between the two spreads. Here's a question from AY. Do I wait until expiration, or do I sometimes close the trade earlier? Do I ever close just one of the spreads? I backtested closing one side using various loss criteria, such as the spread being down 50%. The results were bad. Sometimes what appeared to be the losing spread ended up being the winning one. In general, I wait until expiration. These 3X ETFs can be very volatile. Picking one side over the other is futile. Occasionally, I'll see a profit exceeding the target. Then I'll grab the money and run. Who wouldn't? Mike asks, what do you do if your option is exercised? Well, tell your broker, preferably in advance, to close your entire position as soon as possible whenever that happens. What is the largest drawdown you can expect? Prior to expiration, you may see almost any drawdown or run up. Often the price lasts only a few seconds. The swings are due to the volatility. The market computers and the market makers frequently can't keep up with their data entry. Mike wants to know, what is the minimum net credit? A net credit is the cost of the trade, namely the sum of the debit plus the trade credit amounts. I avoid trades that start with a net credit below 20 cents. However, sometimes I have to accept 10 cents or 15 cents once I have one of the spreads on. A negative net credit is never accepted. Kathy asks if there is a repair strategy. Well, thank you, Kathy. That's a great question. This situation only arises when the ETFs are between the strikes near expiration. There are two solutions if you are concerned. The first is to roll the spreads into the next month. However, you are assuming the prices will not change. That implies the underlying, such as IWM, will not change either. That provides another alternative, a butterfly on that underlying. Do I see any more questions? Any more? No? Well then, thanks for attending. If you have any more questions, just contact me. Here's an addendum due to Jerry, who asked this after the webinar closed. How is the profit computed? Well, profit is a ratio of gain to risk. Risk is the sum of the debit risk and the credit risk. If we call the debit D and the credit C, the credit risk is 1 minus the credit. It's 1 minus C. Here's a simple example. Let's say D is 25 cents and C is 65 cents. The risk would be 60 cents. Note, this is only an example. Either could be the debit spread. Actually, there are many combinations of possible spreads. I have developed an algorithm that determines the best pair. I've noticed a credit put spread is often thin and difficult to trade. Its equivalent debit spread usually has better volume and is easier to trade. Let's consider two examples. In the first one, we have a rising market. We'll assume TNA gains more than 1 point and TZA loses more than 1. Using the previous data, the debit spread for TNA gains 75 cents. It's calculated as 1 minus the debit. The TZA credit spread expires worthless. It loses 35 cents. The net is 40 cents. So 40 over 60 gives us a 66 2/3% gain. Now let's look at what happens if the market falls. We'll assume TNA loses more than a point and TZA gains more than a point. The TNA debit spread is going to lose 25 cents, namely the amount of the debit. The TZA credit spread keeps the credit. It gains 65 cents. The net is still 40 cents. So the percent gain is again 66 2/3%. If you have any questions that this video doesn't answer, email me at drj001@gmail.com. You can also Skype me or telephone me at 828-863-2233. Thank you very much.